There is a moment, a specific and dreadful singularity in time, when the numbers on the screen cease to be abstract representations of value and become a physical force. It feels like a pressure change in a deep-sea submersible. The air grows thick, your vision narrows. The gentle hum of the digital world is replaced by a high-frequency siren that only you can hear, a silent scream originating from the oldest part of your brain. The red numbers cascade downwards, not in an orderly decline, but in a chaotic, violent waterfall of wealth evaporating into the ether. This is the anatomy of panic. It is a neurological event before it is a financial one. Your stomach clenches, a knot of pure, cold dread. Your heart begins to hammer against your ribs, a primitive drumbeat signaling mortal danger. Your palms sweat. This is not the reaction of a rational modern investor. This is the physiological response of a hominid on the ancient savanna, spotting a predator in the tall grass. It is the fight-or-flight response, a magnificent piece of evolutionary software perfected over millions of years to save you from lions, and it is the single greatest liability you possess in the modern world of investing. That ancient wiring, that primal instinct to flee from perceived danger, is the very mechanism that ensures the average person will systematically destroy their wealth over a lifetime. It is the bug in the human operating system, a flaw so profound that it renders intellect, analysis, and information utterly irrelevant in the moments that matter most. We have been sold a dangerous myth. The myth is that the most successful investors are the ones with the highest IQs, the most complex algorithms, the fastest access to information, or the most prescient ability to predict the future. This is a comforting lie, because it suggests that success is merely a matter of acquiring more data, more intelligence, more speed. But the stark, brutal reality is that the financial markets are a battlefield where the war is waged not against others, but against the flawed architecture of your own mind. The market's primary function is to exploit the neurological weaknesses hardwired into your brainstem. It is an engine designed to generate the maximum possible amount of fear and greed, and then siphon wealth from those who succumb to these primal emotions into the accounts of those who have mastered them. The great secret, the one that separates the icons of wealth from the masses, is this: financial success is not an intellectual game. It is a temperamental one. It is not about what you know. It is about how you behave when you are terrified, or when you are ecstatic. It is about the deliberate construction of a cognitive fortress, a mental operating system designed specifically to override your most powerful and destructive instincts. And no one in human history has built a more impenetrable fortress than Warren Buffett. For over 70 years, he has navigated the most violent economic storms, crashes, recessions, bubbles, and panics, not just surviving, but systematically profiting from them on a scale that beggars belief. He has done this not by being smarter, but by thinking differently. He runs a different mental software. While the rest of the world is reacting to the market's chaos, Buffett is calmly interacting with a single, imaginary individual. A character. A business partner he has known his entire life. A partner who is brilliant, resourceful, but also dangerously unstable. A partner who is, for all intents and purposes, a manic-depressive billionaire. This documentary is not about how to pick stocks. It is not about balance sheets or price-to-earnings ratios. It is a deconstruction of that mental software. We are going to give you the source code to Warren Buffett's psychological operating system for emotional control, a system so powerful that it inverts the very nature of risk and fear. We are going to dismantle the allegory of Mr. Market, not as a charming story, but as the most sophisticated cognitive tool ever devised for wealth creation. Prepare to uninstall the primal software that keeps you poor and install the architectural blueprint for profiting from panic. The story of Mr. Market, and by extension the story of modern investing psychology, begins not in the frenetic trading pits of New York, but in the quiet, academic mind of a man who experienced the absolute depths of financial ruin, Benjamin Graham. To understand the tool, you must first understand the crucible in which it was forged. Graham was not a creature of Wall Street's speculative frenzy. He was a product of its catastrophic failures. He saw firsthand what happens when human emotion, amplified by leverage and speculation, runs rampant. He lived through the crash of 1929 and the subsequent Great Depression, an economic cataclysm that didn't just wipe out fortunes, it vaporized the very idea of financial security for an entire generation. Graham watched as brilliant men, titans of industry and finance, were reduced to selling apples on street corners. He saw that their intelligence was no defense. Their sophisticated understanding of economics did not save them. In the face of overwhelming, systemic panic, their rational minds were hijacked by the same primal fear that gripped the shoeshine boy. This profound observation became the central obsession of Graham's life. If intellect is not the answer, what is? If the smartest people can be ruined by their emotions, then the entire foundation of investing strategy had to be rebuilt from the ground up. The problem was not analytical, it was psychological. The solution, therefore, could not be a better formula for predicting prices. The solution had to be a better framework for controlling behavior. This led him to write the two foundational texts of value investing, Depend, Security Analysis, and The Intelligent Investor. The former was a dense, technical manual on how to calculate the intrinsic value of a business. It was the what. But the latter, The Intelligent Investor, was his true masterpiece. It was the how. It was a book not about finance, but about psychology. It was an operating manual for the human mind in the face of uncertainty. And at its very heart, nestled in Chapter 8, was a simple, 3-page allegory that would change the world of finance forever. It was the story of Mr. Market. Graham knew that to defeat a primal, emotional force, you couldn't fight it with cold, hard logic alone. The human brain doesn't work that way. When fear takes over, the analytical prefrontal cortex begins to shut down, and the ancient reactive amygdala takes control. You cannot reason with a panic attack. Instead, Graham did something revolutionary. He used a story. He created a character to personify the irrational, emotional, and often insane behavior of the stock market. He gave the enemy a face. Let's meet him. Graham asks you to imagine that you are in a private business partnership with a man named Mr. Market. He is your partner in every enterprise you own. He is a diligent partner. Every single day, without fail, he shows up at your door and offers you a price at which he is willing to either buy your share of the business or sell you his. There is, however, a critical detail about your partner. He suffers from incurable emotional problems. He is a manic-depressive. Some days Mr. Market awakens in a state of wild, uncontrollable euphoria. The sun is shining, the birds are singing, and he is utterly convinced that your shared business is the greatest enterprise in human history. He sees nothing but a future of limitless growth and infinite prosperity. On these days, he pounds on your door, his eyes wide with excitement, and quotes you a ridiculously high price for your shares. The price he offers is so far beyond any rational calculation of the business's value that you can only marvel at his optimism. He is desperate to buy you out, to own more of this incredible venture. Other days, however, are different. On other days, Mr. Market awakens in the depths of a black, crippling depression. The world is a dark and terrifying place. He is convinced that your business, and indeed the entire global economy, is headed for immediate and certain doom. He sees nothing but bankruptcy, ruin, and despair on the horizon. On these days, he shuffles to your door, his face ashen with fear, and quotes you a price that is pathetically low. He is terrified. He needs to get out. He will sell you his share of the business for a fraction of its true worth, just to have the cash, just to feel some semblance of safety from the impending apocalypse. This is the character of Mr. Market. He is your constant companion on your investment journey. But Graham adds one final, crucial element to the allegory, and it is the key that unlocks its true power. He writes, "The investor is free to disregard his daily quotation. He should be happy to sell out to him when he quotes ridiculously high prices and equally happy to buy from him when his prices are low. But the rest of the time he will be wiser to form his own ideas of the value of his holdings and operate on that basis. Within this simple paragraph lies a complete psychological operating system that, when fully installed, creates an almost unbreakable shield against the two most destructive forces in finance: fear and greed. Let's deconstruct the revolutionary genius of this mental model piece by piece. First and most importantly, the allegory performs a radical act of cognitive reframing. Before Graham, the dominant perception of the market, whether implicit or explicit, was that of a judge. The daily stock price was seen as a verdict, a constantly updated, all-knowing judgment on the value of a company, and, by extension, on the wisdom of your decision to own it. If the price went up, the market was telling you that you were smart. You received a dopamine hit of validation. If the price went down, the market was telling you that you were a fool. You received a cortisol surge of punishment. In this paradigm, the investor is a passive, subordinate actor, constantly seeking the approval of a powerful, omniscient entity. Their emotional state is inextricably linked to the market's daily whims. They are its servant. The Mr. Market allegory shatters this paradigm with one elegant stroke. It inverts the power dynamic completely. The market is no longer a wise judge, it is your unstable, emotionally erratic business partner. Its daily price quote is not a verdict on value. It is merely an asterisk offer from a man who is often out of his mind. The source of authority shifts instantaneously. Suddenly, you are no longer the servant. You are the master. You are the sane partner in the relationship. You are the one who gets to decide whether your partner's offer is rational or ludicrous. The market's opinion becomes irrelevant. The only thing that matters is your own, independently arrived-at assessment of the business's value. This is a profound psychological liberation. It decouples your emotional state from the market's daily fluctuations. A falling price is no longer a judgment that you are wrong. It is simply a more attractive offer from your depressed partner. A rising price is no longer validation that you are a genius. It is a potentially euphoric offer you might consider accepting. The market's mood is his problem, not yours. This single act of reframing, from market as judge to market as unstable partner, is the foundational layer of Buffett's emotional fortress. To see its power, we need only look at the history of financial manias, which are nothing more than Mr. Market in his most extreme state of euphoria. Consider the Dutch tulip mania of the 1630s. For a brief period, the price of a single tulip bulb, a flower, escalated to absurd heights, at its peak costing more than a grand Amsterdam house. People sold their life savings, their homes, their businesses, to speculate on these bulbs. Why? Because they saw the rising price as a verdict from a wise judge. Every day the price went up, the market was telling them that the bulbs were more valuable, and that the people buying them were smart. They were slaves to the price. An investor armed with the Mr. Market mental model would have seen the situation entirely differently. They would have seen their manic partner, Mr. Market, showing up every day, breathless with excitement, offering to buy their flower bulb for a price that was completely detached from its intrinsic value as a flower. They would have calmly formed their own idea of the bulb's value and seen the lunatic prices being offered, would have been happy to sell out to him. They would have sold their bulbs to the euphoric crowd, not because they predicted the crash, but because their partner was offering a deal too good to refuse. Now consider the opposite extreme, the dot-com crash of 2000 to 2002. After years of manic euphoria, where any company with .com in its name was awarded a multi-billion-dollar valuation, the bubble burst. Mr. Market went from euphoric to suicidal. The Nasdaq index fell nearly 80%. Great, durable technology companies with real earnings and solid futures, companies like Microsoft, Intel, and Cisco, saw their stock prices collapse by 60%, 70%, even 80%. The average investor who still saw the market as a judge was terrified. The plunging prices were a damning verdict. You were a fool to invest in technology? Get out now before it goes to zero. They sold in a panic, locking in catastrophic losses. But the investor running the Mr. Market OS saw a different reality. They saw their deeply depressed partner, Mr. Market, shuffling to their door, whispering that the world was ending and that he would be willing to sell his share in a dominant, world-changing franchise like Microsoft for a fraction of its long-term earning power. The intelligent investor, having done their own analysis and formed their own idea of value, would have been equally happy to buy from him. They would have seen the panic not as a threat, but as a once-in-a-generation opportunity being served up by their bipolar partner. This cognitive inversion, this fundamental shift in the power dynamic between you and the market, is the first and most critical step. But it is only the beginning. The allegory is not just a philosophical stance. It is an operating system with two core pillars of execution. These pillars are the practical application of the allegory, the how-to that transforms the story into a repeatable process for building wealth. Pillar 1 is the establishment of an internal, unshakable reality. Pillar 2 is the strategic exploitation of an external, irrational reality. Let us begin with the first, and arguably the most difficult pillar, the sanctity of intrinsic value. The Mr. Market operating system is predicated on a single, non-negotiable assumption: that you, the intelligent investor, are capable of determining a rational estimate of a business's underlying value, and that this estimate must be held entirely separate from the price quoted by the market. Your valuation is your anchor in the storm of market emotion. Without it, you are lost. Mr. Market's greatest weapon against you is the psychological bias known as anchoring. The human brain is not built to consider value in a vacuum. We latch onto the first piece of information we are given and use it as a reference point for all subsequent judgments. In finance, the first piece of information you almost always see is the stock price. This is a disaster. The moment you see that price, Mr. Market has infected your thinking. If you are analyzing a company and see its stock price as $100, your brain will subconsciously anchor to that number. Your subsequent analysis will be biased towards justifying a value somewhere around $100. If the price were $50 or $200, your final valuation would likely be pulled in that direction. The price, which should be the very last thing you consider, becomes the starting point of your analysis, poisoning the entire process. Buffett's operational discipline is designed to combat this anchoring effect with extreme prejudice. His process is a masterclass in building a psychological firewall. He has famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." The emphasis is always on the asterisk company first. He and his partner, Charlie Munger, begin their work by reading. They read annual reports, trade journals, industry analyses. They immerse themselves in the reality of the business itself. What does it sell? What is its competitive advantage? Who are its managers? What are its long-term prospects? They are attempting to build a complete mental model of the business as a living, breathing entity, completely divorced from its status as a flickering symbol on a stock ticker. They are trying to answer one question and one question only: if I had enough money, would I want to own this entire business forever? Notice what is absent from this process: the stock price. They are deliberately and systematically ignoring Mr. Market. They are not letting his manic or depressive opinion enter the room while they conduct their calm, rational analysis. Only after they have arrived at a firm, defensible estimate of what the entire business is worth, its intrinsic value, do they then, and only then, glance at the stock price. This is the moment of truth. They take their internal, protected calculation of value and compare it to the external price being offered by Mr. Market. The price is no longer an anchor. It is simply data point to be compared against their pre-established reality. If their valuation of the business comes out to, say, $150 per share, and they look and see Mr. Market is offering to sell his shares at $200 in a fit of euphoria, the decision is simple. They do nothing. The offer is unattractive. They thank their partner for his enthusiasm and wait. If, however, they see Mr. Market offering to sell his shares at $80 in a fit of depression, the decision is also simple. They act decisively and buy, because the offer is compelling. The secret lies in the sequence. Analysis first, price last. Internal reality first, external offer second. This discipline requires the cultivation of what we will call an information quarantine protocol. The aspiring elite investor must recognize that the vast majority of financial information produced by the world is not just useless, but actively harmful. It is noise designed to trigger your emotional responses, to make you feel that you must do something. The 24/7 cable news cycle, the constant stream of analyst upgrades and downgrades, the minute-by-minute market updates, this is not information. This is Mr. Market whispering in your ear, trying to make you as manic or depressive as he is. To install Buffett's OS, you must build a fortress against this noise. This means a radical shift in your information diet. Stop watching financial news. Stop reading market forecasts. Stop listening to pundits who claim to know where the market is headed next. Buffett himself has said he could be happy if stock market quotes were only available once a year. Your new diet consists of primary sources. You read the annual reports of the companies you are interested in. You read letters to shareholders from managers you admire. You read the great books on investing and business. You are building your own circle of competence, your own deep understanding, insulated from the hysterical noise of the crowd. This pillar, the sanctity of intrinsic value, is about building your internal reality. It is the defensive part of the system. It is the hard, intellectual work of forming your own convictions so that you are not swayed by the madness of others. But defense alone does not win the game. The true genius of the Mr. Market system is how it seamlessly integrates this defensive posture with an aggressive, opportunistic offense. This brings us to the second pillar, the price as an external offer. Once you have established your own, independent calculation of a business's value, you have fundamentally changed your relationship with stock prices. A price is no longer a measure of value. It is not information. It is simply an offer. This is a profound distinction. Every day, Mr. Market provides you with a stream of offers to either buy your assets or sell you his. Your job is to sift through these offers and identify the ones where his emotional state has created a significant discrepancy between the price he is offering and the value you have calculated. You are in essence an emotional arbitrageur. You are exploiting the gap between your partner's mood and reality. The wider that gap, the greater your opportunity. Buffett has provided a perfect analogy for this mindset. He calls it the 20-slot punch card. He says to imagine that over your entire lifetime as an investor, you have a punch card with only 20 slots on it. Every time you make an investment, you have to punch one of those slots. Once you've punched all 20, you can't make another investment. This mental model forces you to treat every decision with the gravity it deserves. You are not looking for a quick trade. You are not looking for something that might go up a little bit. You are waiting, patiently, for the absolute perfect pitch. You are waiting for the day when Mr. Market's emotional breakdown is so severe that he offers you a truly extraordinary deal on a wonderful business. Most of the time, his offers will be in the realm of reasonable. The price might be a little high, a little low, but it's not compelling enough to use one of your precious 20 punches. So on most days, your job is to do nothing. You sit and wait. You read. You learn. You strengthen your understanding of your businesses. You let your manic-depressive partner rant and rave, paying him no mind, until the day he has a complete psychological collapse. And on that day, you act. You act with conviction, and you act at scale. This philosophy is the polar opposite of the hyperactive trade-every-minute mentality that Wall Street promotes. It is a philosophy of profound, strategic inaction, punctuated by moments of extreme, decisive action. Let's examine this pillar in action through one of Buffett's greatest trades, a masterclass in exploiting Mr. Market's deepest fears, his investment in American Express during the Salad Oil scandal of 1963. American Express in the early 1960s was a wonderful business. It had two main pillars: its travelers' checks and credit card businesses, which were essentially a float-generating machine, and its warehousing business. A small subsidiary of the warehousing business, based in New Jersey, made loans to a company called Allied Crude Vegetable Oil. The loans were secured by the supposed collateral of giant vats of salad oil. Then, disaster struck. It was discovered that Allied Crude was a massive fraud. Its founder, Tino De Angelis, had filled the vats mostly with water, with only a thin layer of oil on top to fool the inspectors. When the fraud was revealed, Allied Crude collapsed, defaulting on its loans. American Express was on the hook for potentially catastrophic losses, estimated to be as high as $60 million, a huge sum for the company at the time. Mr. Market had a complete nervous breakdown. He entered a state of suicidal depression. Wall Street panicked. The story was that American Express, a trusted blue-chip institution, was involved in a sordid fraud and could be facing bankruptcy. The stock price was annihilated, falling almost 50% in a matter of months. This was Mr. Market screaming, "The world is ending. American Express is doomed. Sell everything before it goes to zero." An army of analysts and investors, seeing the market as a judge, agreed with this verdict and dumped their shares in a panic. But Warren Buffett, then a young, relatively unknown fund manager, activated his mental operating system. He ignored the screaming. He ignored the price collapse. He started with Pillar 1, building his own independent reality. He didn't ask, "Why is the stock going down?" He asked, "Is the fundamental long-term earning power of the core American Express business permanently impaired by this warehouse problem?" To answer this, he didn't read Wall Street reports. He did his own scuttlebutt research. He went to banks. He went to travel agencies. He went to restaurants. He would stand in line and observe customers. Were people still using American Express travelers' checks? Were they still using their credit cards? He spoke to merchants. Were they still accepting American Express? The answer he found was an overwhelming yes. The scandal, while a major financial hit and an embarrassment, had done almost nothing to damage the company's powerful brand or its core operations in the minds of its customers. The franchise was intact. He concluded that the long-term earning power of the business was still there. The warehouse division was a problem, but it was a survivable one. He had established his internal reality. Now he turned to Pillar 2, analyzing the external offer. His depressed partner, Mr. Market, was offering to sell him shares in this wonderful, durable franchise for a price that implied the company was on the verge of collapse. The gap between Buffett's calculated intrinsic value and the market's quoted price was enormous. It was the perfect pitch. It was an opportunity to use one of his 20 punches. So while the rest of the world was selling in a panic, Buffett acted. He invested 40% of his partnership's capital, a colossal bet, into American Express stock. He was buying from his terrified partner at a price born of pure fear. Over the next few years, as the company resolved the scandal and its powerful core businesses continued to grow, the stock price recovered and then soared. Buffett made a fortune. He didn't do it by predicting the scandal or its resolution. He did it by having a psychological operating system that allowed him to be rational when everyone else was emotional. He used Pillar 1 to determine the value, and Pillar 2 to recognize that the price being offered was a gift from a madman. This two-pillar system, internal value, external price, is the engine of the Mr. Market framework, but knowing the strategy is not enough. You can understand the logic perfectly and still fail in the heat of the moment. Why? Because your own brain is a formidable adversary. To truly master this system, you must understand the neurological warfare being waged inside your own skull. You must identify the specific cognitive biases that Mr. Market is designed to exploit, and you must learn how the allegory acts as a direct countermeasure to each one. This brings us to the third, and perhaps most critical part of our deconstruction, hacking the neurological enemy within. The human brain is a marvel of evolution, but it was not designed for the abstract, high-stakes environment of modern financial markets. Our minds are riddled with cognitive shortcuts or heuristics that help us make quick decisions in our daily lives, but become catastrophic liabilities when investing. Mr. Market's wild mood swings are a direct assault on these built-in weaknesses. Let's dissect the most dangerous biases and see how Buffett's OS provides a shield. The first and most powerful bias is loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky revealed a stunning asymmetry in the human mind. The pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $1,000 feels as bad as winning $2,000 feels good. This is a survival mechanism. Our ancestors who felt the pain of losing their food supply more acutely than the joy of finding a new berry patch were more likely to survive and reproduce. In the stock market, this hardwiring is ruinous. When you see the price of your stock falling, the red on the screen activates the same ancient fear centers in your amygdala. The pain is visceral. Loss aversion creates a powerful urge to sell a losing investment, just to make the pain stop. It doesn't matter if the underlying business is still sound. The psychological distress of seeing the quote go down every day becomes unbearable. Mr. Market weaponizes this. In his depressive state, he feeds you a steady diet of lower and lower prices, knowing that your loss aversion will eventually force you to capitulate and sell to him at the point of maximum pain, the very bottom. How does the allegory counteract this? By reframing the very definition of loss. For the average person, a lower stock price pain, keys bas a loss. For the investor running the Mr. Market OS, a lower stock price is not a loss. It is a more attractive offer from your business partner. It is an opportunity. The emotional sting is neutralized because the event is no longer framed as a negative, losing money, but as a positive, being offered a better deal. When Buffett saw American Express stock fall by 50%, his brain didn't register, "I am losing half my money." It registered, "My partner is now twice as desperate to sell me his share of this great business." This cognitive shift short-circuits the loss aversion mechanism. You are no longer a victim of the falling price. You are its potential beneficiary. The second major bias is social proof, or the herding instinct. We are social creatures. For millennia, our survival depended on our ability to stick with the tribe. The individual who wandered off alone was far more likely to be eaten. As a result, we have a deep-seated instinct to do what everyone else is doing. When we are uncertain, we look to the actions of others as a guide to the correct behavior. In the market, this is a recipe for disaster. Mr. Market is the herd. His manic phase is the euphoric roar of the crowd, convincing everyone to pile into an asset at its peak. His depressive phase is the stampede for the exits, where the panic of the herd creates a self-reinforcing downward spiral. Social proof is the engine of bubbles and crashes. The pressure to conform is immense. When everyone around you is panicking and selling, every fiber of your being screams at you to do the same. To stand apart from the herd is to feel isolated, foolish, and exposed. The Mr. Market allegory is a powerful antidote to this instinct. By its very design, it forces you into a contrarian position. The allegory frames your relationship with the market as a two-person partnership. It's just you and him. The crowd disappears from the mental picture. You are not transacting with millions of other people. You are transacting with one unstable individual. Your goal is not to agree with him, but to take advantage of his emotional errors. The framework presupposes that your partner will frequently be wrong, and that your success depends on your ability to disagree with him. It transforms the act of going against the crowd from a terrifying act of social deviance into the entire point of the game. You are not trying to be part of the herd. You are trying to be the rational shepherd who profits from the herd's predictable and irrational movements. When the herd is stampeding off the cliff, the allegory gives you the psychological permission to stand still, and then to calmly walk over and buy the assets they dropped in their terror. A third bias, closely related to the first, is anchoring bias, which we touched upon earlier but deserves a deeper look. Mr. Market's daily quote is a powerful anchor that tethers your perception of value to his current mood. This is particularly dangerous during bubbles. In 1999, at the height of the dot-com mania, a company like Pets.com could have an initial public offering at $14 per share. Mr. Market was euphoric. That $14 became a powerful anchor. Investors anchored to that price, and when it went up to $16, they felt they were getting a good deal confirmed by the market. They never stopped to do the independent work of Pillar 1 and ask the fundamental question: what is the intrinsic value of a business that sells pet food online at a loss? Their entire reality was anchored to the market's insane starting point. A year later, the company was bankrupt and the stock was worthless. The Mr. Market framework protects you by forcing you to create your own anchor. Company was tarde before Tompany were exposed to his. Your anchor is your own, privately calculated intrinsic value. When you have done the work and concluded that Pets.com has a negative intrinsic value because its business model is fundamentally broken, Mr. Market's offer of $14 per share is not an anchor. It is a punchline to a joke. You can laugh at his absurdity rather than be seduced by it. Finally, let's consider recency bias. The human brain has a tendency to overweight recent events and project them indefinitely into the future. When the market has been going up for several years, we start to believe that it will go up forever. Greed takes over. This is Mr. Market in his manic phase, whispering that this time is different, that the old rules no longer apply. Conversely, after a brutal market crash, we become overly pessimistic. We project the recent pain and fear into the future, believing that the market will never recover. This is Mr. Market in his depressive phase, convincing you that the darkness is permanent. Recency bias is what causes investors to buy at the top, after a long run-up has made them feel safe, and sell at the bottom, after a crash has convinced them there is no hope. The Mr. Market OS smashes this bias by grounding you in the long-term reality of the business. When you are focused on the durable earning power of a company over the next 10 or 20 years, the market's mood over the past 10 days becomes almost comically irrelevant. The allegory encourages you to adopt a different timescale. You are not a speculator renting a stock for a few weeks. You are a business owner with a partner. Your focus is on the long-term health and profitability of your enterprise, not on your partner's fleeting emotional state. This long-term perspective acts as a powerful buffer against the short-term noise and emotional volatility that drives recency bias. By understanding these biases, loss aversion, social proof, anchoring, and recency, you begin to see that Mr. Market is not just a story. It is a targeted, multi-pronged psychological defense system. It is a piece of cognitive software designed to identify and neutralize the most dangerous bugs in your own mental hardware. But like any sophisticated software, it requires a deliberate and disciplined installation process. You cannot simply hear the story and be transformed. You must integrate it into your daily thoughts and behaviors until it becomes an automatic, intuitive part of your decision-making process. This brings us to the final and most practical stage, the installation and execution of the Mr. Market operating system. This is where theory becomes practice. This is the blueprint for rewiring your brain. The installation process can be broken down into 3 core habits, or protocols, that must be practiced relentlessly until they become second nature. Protocol 1. The information quarantine. As we discussed, you must seize control of the information you allow into your mind. Your first practical step is to conduct a ruthless audit of your information sources. For the next 30 days, commit to a strict quarantine. No financial television, no news articles about daily market movements, no social media feeds filled with stock tips and frantic commentary. Unsubscribe from all of it. Your goal is to create a space of profound mental silence. In this silence, you will replace the noise with signal. Your information diet will now consist of only 2 things. First, primary source documents from the companies you wish to understand, which means reading at least the last 5 years of annual reports and shareholder letters. Second, you will read foundational books on business and investing philosophy. You are not looking for tips. you are looking for mental models. The goal of the quarantine is to break your addiction to the market's daily noise and to prove to yourself that you do not need it. You will discover that your ability to think clearly and focus on long-term value increases exponentially when you are not being constantly bombarded by Mr. Market's emotional static. After 30 days, you can decide what, if any, external sources to let back in, but you will do so from a position of strength and intention, not out of habit or fear of missing out. Protocol 2. The pre-mortem of panic. The time to prepare for a storm is not when the hurricane is raging, but when the sun is shining. The time to master your fear is not in the midst of a market crash, but in moments of calm rationality. The pre-mortem of panic is a powerful psychological exercise to preemptively neutralize your future emotional reactions. For every investment you own or are considering owning, you will perform this written exercise. You will sit down with a piece of paper or a blank document and write out the answers to the following questions. 1. I have just purchased this stock at $100 per share. Tomorrow, due to a market-wide panic that has nothing to do with the company's fundamentals, the stock price drops to $50. Write, in detail, exactly how I will feel. Be honest. You will feel fear, regret, stupidity. You will feel the urge to sell. Write it all down. By articulating the emotion in advance, you rob it of its power. 2. In that scenario, where the price has been cut in half for no fundamental reason, what will my actions be? What is my predetermined plan? Your plan should be based on the Mr. Market OS. For example, I will first verify that the news causing the panic has not permanently impaired the company's long-term earning power. If it has not, I will recognize that my depressed partner is offering me a wonderful opportunity. I will not sell. Instead, I will consider this a strong signal to buy more, assuming I have available capital. 3. What specific fundamental metrics would have to change for me to determine that my original thesis is wrong and I should sell? This is crucial. It defines the difference between a falling stock price and a deteriorating business. Your selling decision must be tied to the reality of the business. E.g., they lost their key patent, their debt has become unmanageable, not to the emotions of Mr. Market. By writing this document for each investment, you are creating a contract with your future, more emotional self. When the inevitable panic comes, you will not have to think. You will simply execute the rational plan you made when you were calm. Protocol 3. The Business Partner Journal. To make the allegory of Mr. Market a living, breathing part of your mind, you must interact with it daily. The Business Partner Journal is a simple but profound habit. At the end of each day or each week, you will take 5 minutes to write a short journal entry about your interactions with your partner, Mr. Market. The entry might look something like this. Today, Mr. Market was in a foul mood. He was worried about the Federal Reserve raising interest rates and became convinced our businesses were worth 10% less than yesterday. He offered to sell me his shares in Coca-Cola at a very reasonable price. I did nothing as the price is not yet compelling enough, but I thanked him for the offer and noted his deepening pessimism. Or, on another day, Mr. Market was euphoric today. A positive inflation report sent him into a frenzy. He offered to buy my shares in American Express for a price 20% higher than my most optimistic estimate of its value. I was tempted by his enthusiasm, but my analysis says the business is not worth that much, so I politely declined his very generous offer. This simple act of personification and journaling does something remarkable. It forces you, on a daily basis, to practice the cognitive reframing at the heart of the system. It trains your brain to see market fluctuations not as abstract, threatening data points, but as the predictable emotional swings of your erratic but ultimately useful partner. It makes the allegory real. It makes the mindset automatic. By implementing these 3 protocols, the information quarantine, the pre-mortem of panic, and the business partner journal, you are no longer passively learning about a mental model. You are actively installing it. You are rewriting the code of your financial mind. You are building, brick by brick, the impenetrable cognitive fortress that will protect you from yourself and allow you to thrive in the chaos that destroys others. This is the secret. This is the profound truth at the heart of Buffett's success. His fortune was not built on a superior ability to predict the future. It was built on a superior ability to control the present, to control his own mind, his own emotions, and his own behavior in the face of an uncertain and often terrifying world. The Mr. Market operating system is the tool that allows for that control. It is the psychological architecture that separates the intelligent investor from the speculator. It provides the essential temperamental foundation, the unshakable calm, that allows you to remain rational when everyone around you is succumbing to the primal software failures of fear and greed. It gives you the power to see a market crash not as a disaster to be feared, but as an opportunity to be embraced. It tells you when the best opportunities are likely to appear. They appear when your partner is in the depths of despair. But mastering your temperament is only the first half of the equation. This operating system provides the psychological fortitude to act when others are paralyzed by fear. It gets you to the plate during the most critical moments of the game. However, once you are there, standing in the batter's box with a perfect pitch coming your way, another question arises. A critical, quantitative question. How hard should you swing? How do you ensure that even if your timing is a little off, or your analysis is slightly flawed, you still don't strike out? Having the courage to buy during a panic is one thing. Knowing precisely what price to pay to build in a massive buffer against error and uncertainty is another entirely. This requires a second, equally powerful mental model. Not just a psychological shield, but a systematic, mathematical rule for financial survival. It is the engineering principle that ensures your financial fortress can withstand any attack, including the ones you never see coming. That system, that cognitive fortress against error and an unpredictable future, has a name. It is Warren Buffett's single most important rule, the three most important words in all of investing, and the absolute cornerstone of his entire $90 billion empire, the margin of safety. To fully deconstruct that three-pillared system for building true financial invincibility, you need to click the video that is now appearing on your screen. It is the logical, essential, and non-negotiable next step in installing Warren Buffett's complete mental operating system for wealth creation. Click the video now. The next stage of your education begins there.